Ladies and gentlemen, welcome to another episode of the Resource Insider Podcast. Today on the podcast, I sat down for a chat with Mark O'Day and Peter Bell from Northwest Copper. This was a very interesting conversation. We got into, of course, Mark and Peter's background. Peter has been a fund manager, he's been an investment banker, and most importantly, he's been a long-term geologist with Newmont Gold. So he has a huge track record, a ton of experience, and a lot of great insight to pass on to listeners. I got a lot out of it. I think you're going to get a lot out of it. If you're interested in copper, if you're interested in exploration, if you're interested in how to make money investing in mining stocks, this is the episode for you. So, without further ado, let me please introduce Mark O'Day, Peter Bell from Northwest Copper. Gentlemen, thank you very much for making the time today. I was going to say thanks for making the trip, but since neither of you actually have to leave home to do anything anymore, it's not so bad, I guess.
Thanks, Jamie. It's good to be here again, even though it's not in the comfort of at our kitchen table. Last time we did one of these interviews.
I know. I think last time I had donuts, and I'm a little sad to be missing them this time.
So we don't even get donuts this time.
Mark, you're at home in Deep Cove. Peter, where are you right now? Where are you joining us from?
I'm in Toronto today.
Okay. So, guys, this is a new company. It's a new team. Mark, you've been here before, and for anyone who has not checked out my podcast with Mark O'Day, I highly recommend it. We do get into his background and the Oxygen Capital and a lot of the work he's done and really his philosophy on building companies. And it will lend itself to the conversation we were about to have because this is a new company that Mark and team are building. But Peter, for people who've never heard of you before, who you've never been on the podcast, can you give us the, literally the 30,000 two-sentence overview of your career, and we're going to get into that in some more detail?
Sure. That's so I spent about 15 or 16 years as a geologist, including a big chunk of that with Newmont Mining all over the world, although I started off here in Canada, and then moved to London, spent 10 years working for and at a hedge fund there on the buy side. 3 years in mining investment banking here in Toronto, and then I'm happy to join Mark in this opportunity with Northwest Copper.
Okay. And Mark, I think maybe one of the best places we can start here, before we get into the details and before we kind of really dive into Peter's background, is an overview of what Northwest Copper is and how that came to be.
So when you think of the word synergy, it really means the whole is greater than the sum of the parts. And Northwest Copper is sort of the epitome of that incarnate. So it's two companies that were brought together that were next door neighbors that share a lot of synergies from exploration and development and operational points of view that intrinsically belong together. And they each make up for what the other one may be lacking in. So we end up with a combined series of assets that both now have high grade and tonnage. So we have a project that we think now shares the best of both worlds there in terms of grade and critical mass, that on a combined basis is a lot more developable. And so these were next door neighbors, literally next door neighbors. We share a claim boundary. We can see each other's project from the hill. One's in the valley, one's up on the hill. We're both copper gold. And they were sort of screaming out, just from an industrial logic point of view, we were screaming out to join forces. And so we put this deal together before Christmas. We announced it. It sort of got consummated and finalized about a month ago. And we've been out marketing the story, and we raised a little bit of additional money to bolster the treasury and have a real war chest to get out there and move these projects forward.
So these are the Quinique and Stardust projects, right?
Correct.
And
so Stardust came from Sun Metals and Quinique came from Serengeti.
So, something I think a lot of people don't think about this is often the way that assets are divided can be somewhat arbitrary, right? a company owns this, another company owns that, and you might think that there's a reason for that, but sometimes it's just because that's what's available at the time, or that's what they can get their hands on, and it doesn't really necessarily respect the geological boundaries of the deposit. So, I mean, I guess the concept behind Northwest Copper and consolidating these assets is you're trying to build a company based on the real geological boundaries versus what you could actually stake or acquire at the time.
Well, even though they're distinct deposits and separate separate genetic makeup, right? Mm-hmm. One's a porphyry and one's a CRD massive sulfide deposit, and they're separated by a fault, so they're not geologically linked, but they are geographically linked, being effectively in the same development footprint and the same commodities. Okay. So it makes great sort of industrial sense to put them together.
So you've started the company. You guys raised, I believe, $13 million recently. You've brought on Peter Bell as the president and CEO. You're going to be taking the role as chairman or executive chairman. Why don't you tell me, before we start talking to Peter, why you recruited him to the next Oxygen Capital company, and we can get into his background in finance and geology and all the rest.
Yeah, I'd love to. I've known Peter for over 10 years. I think it's more like 14 years. And I met him when he was based in London running a fund, or an analyst for a fund called Polygon, which morphed into Hawks Point. And he can give you the history of sort of the funds over there. But I got to know him over that decade, and he was always a guy who had a critical eye for the technical merits of a project, identifying problems and opportunities, but really sort of seeing through any kind of promotional flair that might be there, right down into the nuts and bolts of a project. So he approached his side of the business with great technical rigor. So that was important to me. He's a guy who is well respected on the street for his tough approach to projects. All right, he was never an easy sell on anything. And then his most recent experience as an investment banker, coming over to this side of the fence, sort of the sell side, sort of rounded out his market-facing experience and his sort of financial resume, so to speak. And so what you end up with is a guy who combines both the technical strengths that you want to see in a CEO, because I wasn't looking for a CEO who was an accountant or a lawyer. I want a CEO who's got the chops and he's got the technical know-how to identify a project he likes and go after it, but also a guy who is not just technical, but market-facing enough, who he knows the street, he knows the accounts, he knows the funds that are out there, he knows the space, he's done the market research. And so he's a unique combination of all those things. And we started talking, a couple of months ago about this opportunity, and it seemed to intrigue him. And we sort of worked from there and came to an agreement. And we're delighted that he's come over as CEO. I think it's a great addition to the team.
All right, that's a glowing introduction. So, Peter. I did some research into you prior to this conversation, and one of the people I chatted with said Peter has viewed over 500 projects throughout his career. That sounds like a lot of time on an airplane. Is that true? And how did that happen?
It's true. I've spent a lot of time on an airplane, and yes, I did count up the number of. So when I was at Polygon, we had a slide in our investor deck that showed the different places that I'd been to, and I've added some since then. So yeah, it's a pretty high number of projects that I've been to.
And so let's talk about what your role in that actually was. So were you doing this when you were at a bank or at a fund, or were you doing this during your time at Newmont? And when you go to these projects, what is your goal when you go there?
Sure. Yeah, totally fair question. And I've done it with a few different hats on, as you point out. So, my initial work in looking at projects was with Newmont. And, I kind of, as I worked through the ranks of Newmont, from working in the exploration group at Carlin, working on the discovery of the Leeville deposit in Nevada in the kind of mid-90s, and then working in other parts of the world, eventually working down in Peru for Newmont, where I was the chief geologist at Yanacocha. I got the opportunity to help out other groups in terms of doing due diligence for opportunities that Newmont would look at. And Newmont at the time, and Newmont I'm sure now, is expected, the technical team there is expected to know something about almost every gold, copper type deposit or gold deposit in the world. So we traveled around and we looked at all of them for different reasons. And in my last couple of years at Newmont, I worked in the technical services group, and it was partly a business development role, and that's where I really started going and looking at multiple projects in a month and doing that kind of heavy airplane travel that kind of morphed to what I did on the fund side. And really, there's a huge amount of value in visiting a project as an investor, as a potential buyer, as in all those kinds of roles, even as a lender, which I did some work for at National. You're initially, you want to know, what does it look like getting to the project? What's the access like? What are the people like? How welcome do you feel? How unwelcome do you feel? What's the security like? What are the logistics like? What's the landscape like? How hard is it to get there? And from there you go to probably the most important thing, which is really, what's the team like on the ground? It's one thing to meet the CEO in your office in London or Toronto or wherever, but it's another thing to get out on the ground and talk to the people who are actually doing the work and see how deep the team is and how deep their understanding is, and also what their relationship is with what they're doing, but also with the people in the region. So and then you dig into the details, the technical details on geology, metallurgy, resource model, infrastructure, all those kinds of things. But ultimately it's the opportunity to see who's on the ground doing the work, and what your view of that is and what the risks are going to be and opportunities.
So, okay, what I think interests me personally about this is the lens you put a project under when you're wearing different hats, when you're working at a Newmont, when you're working at a fund versus when you're working at an investment bank. So, I think this would be really valuable for people to understand this. And when you're working for the Newmonts of the world, one of the biggest gold miners in the world, they're looking for massive deposits. I mean, 5 million ounce plus, 10 million ounce plus deposits? Am I right on that?
The number moves around, but they're big deposits for sure. Yep.
What is the lens, what is the back of the envelope that you would want to see at a Newmont to go and, even kind of get on that airplane and make it worth your time to go look at a project? What's your kind of top 5 thing checklist that you want to see?
Well, again, with one of the things that I think differentiates going and looking for a project when you're working for Newmont versus looking from the bank's point of view or as an investor point of view is that Newmont's going to buy and operate this thing. So they need to know it in a lot of detail, in a lot more detail than you might as an investor, believe it or not. So as an investor, you have the opportunity to trade in and out of the company. So
there's no exit opportunity when you own it, I guess. It's your problem to either to run with or
once
fix.
You own the whole thing, you're stuck with it. So, you need to make sure the things you're looking for when you look at a deposit in terms of risk are, to me, from my point of view, and if you look at how they usually fail in 3 big ways. They fail either because now, and this has been true for a while, the social contract, you actually can't get access to the land or you can't develop it or whatever. That's something that is very key. The resource model. So, if there's not metal in the ground, then, there's no money to be made there. And then the metallurgy. And then, beyond that, the engineering and the infrastructure and all those are all things that can be solved with money. They may dampen your ability to do things or whatever, but they tend not to be kind of deal killers. But, again, it comes down to the people and the project, but have the people done anything that makes the project unworkable? And that could be on the social side. It could be on the technical side.
Okay.
So hopefully that's useful.
Yeah, that is useful. And there's a lot of ways I could take that. And, it's interesting. So there's 2 things, I think in the junior mining space and even sort of professional junior mining investors, can often have a bit of blinders on when investing in a deal, or rather in a company, focused on is there metal in the ground, what's the exploration, and they can tend to forget about the social, or, I actually see a lot of people forget about the metallurgy. They completely ignore the metallurgy, especially in the early stage, and definitely exploration, sometimes even up in development. I mean, I guess I'm hammering on a point here, but like, how important was that for you guys? I mean, is that 50% as important as, okay, is there metal in the ground? I assume the metallurgy needs to be considered with equal weighting on that.
Metallurgy is just as important.
Yeah.
Absolutely critical.
It's something we think about a lot at Resource Insider, especially at our sort of development stage and operating projects. And it always amazes me how few people are asking those questions. And I think it's interesting, and it's good to hear you sort of reiterate that.
Yeah, and you can get a sense of the metallurgy even as a geologist, even in the early stages, by asking hard questions about what's the mineralogy, what's the paragenesis, what's the sequence of events of how this deposit has developed, and those give you clues about the metallurgy.
So you're saying it's so easy, even a geologist could do it. Did I understand that right?
We outnumber you, Jamie. There's
That's
two
true.
of us here.
Yeah, exactly.
Two geologists for every one engineer. That seems about fair, I think.
We can form an opinion on it. We need an engineer to come in and finalize.
So how did that change when you moved into the hedge fund world, where you're not operating the project, where you have, depending on the size of your investment, certainly an easier time of exiting? I presume, one of the things that became much more important is the actual team running that and their ability to execute, because you're not taking over and, firing the top guys and putting your own people in place. How does it shift? And this is very relevant to the people listening to this podcast, because it's the situation
absolutely.
most of them find themselves in.
Yeah, and so I wrote down some notes about how we thought about and how I think about those kinds of investments, and what we're looking for is things that are very catalyst rich. So companies that are doing something. So those companies are exploring, growing a resource, they're putting a project into production, they're expanding production, potentially shrinking production, but there's some change that's taking place. And I think, a lot of, I think some people who may invest in mining who have not worked a lot in it don't appreciate how variable a mine can be, how variable the production can be, how variable the costs are, and so on. And it's those variations from what the market is expecting that obviously create the opportunity. So the first thing that I would be looking for is, does this company have the opportunity for something to change? Are they going to ramp up production? Is the grade going to get better? Whatever, are they going to put it into production successfully? So we're very focused on those kinds of opportunities, and then from there. So once you've identified something that has a lot of those moving parts, then the opportunity presents itself for someone who has a technical background to dig into the company and figure out, when is that going to occur? How long is it going to occur? How much is it going to cost? Does the company have enough money to do it? So then you go through kind of the red flag checklist. So you go through, like I mentioned, the resource model, the metallurgy, the design of the mine, is it going to be expanded, to be twice as big as it is now, like for an underground mine, for example? Like, are there reasonable things that are happening, and can you benchmark them against other things that are happening? Then you dig into what you can find out about the social and political side of things in the country they're in, or the region that they're in. And then what's much more important from a fund point of view than it is when you're a Newmont is the financial condition of the company. So, what's their balance sheet like? Do they have debt? If the debt, how's the debt structured relative to how you believe the ramp up or whatever change is going to occur? So does the company have a punitive debt schedule, and they've got a very aggressive ramp up plan? You're looking for kind of mismatches in things and trying to make sure that everything works the way it's meant to and sequences the way it works. And then from there, if a project passes all of those things, then you move on, in my view, to valuation, and then you're comparing it to other similar companies. You build your financial model and figure out whether you think it's whether it's good value or not. And, assuming that it's interesting on all those other counts and it's interesting from a valuation point of view, then you get to the valuation part. But to me, that's kind of something you do a little bit later on.
So you kind of got, I guess you got kind of three parts, right? Like, is there that upside you're looking for? Can it work? And then what's it worth at that point?
Yeah, exactly.
Yeah.
Yeah.
So when you work for a fund like this, and I've gotten my notes here, you had somewhere between $300 and $400 million under management at that fund. Am I right on that?
Yeah, that was what our mining portfolio was like.
And you don't need to get into specifics on this fund if you can't, but generally speaking, what kind of returns are you guys trying to hit in a mining specific fund? And maybe it's worth clarifying what stage you were investing at. Was it producers? Was it explorers, or anything in between?
Well, one of the things that I think it's worth pointing out in terms of trying to target the returns is that we ran a commodity neutral long short fund. So because of that, you control your volatility. So your ups and downs are lower than they otherwise would be. And so your returns are lower, but your risk is lower. So your kind of risk adjusted returns are a bit different than they would be in a straight long only fund.
So you were operating a hedge fund the way it's actually supposed to be operated.
We tried to run it commodity neutral. So we did there's a lot of, that's a long conversation, but that influences the way that I would describe the returns.
Okay. And then what is a target? Is it 5%? Is it 50%? What are you looking for?
A good year would be, you would be targeting trying to get above 10%.
Trying to get above 10%. Okay.
Yeah.
All right. Now, I want to talk for a second about your role at Yanacocha, because Yanacocha, you mentioned that it's in Peru. That's a massive project, right? If I remember correctly, it's about 10 million ounces. Am I right on that?
So, well, the resource is quite a bit bigger than that. And I don't know what the ultimate number is now. But the last year that I was there, we produced a bit over 3.2 million ounces
per year.
So in a year.
Oh, Jesus. So I'm way off on this. So if you could give a ballpark estimate for what the size of this is it 50 million ounces?
50 million ounces. Okay. I don't know what the total resource number is.
All right. Newmont, you're going to be watching this and checking in here, I think, is what's going to happen after this. So, okay. Massive gold project, potentially 50 million ounces, 3 million ounces a year. What was your role there as a geologist? Were you looking to expand this? Were you looking to help, define where you were mining and optimize the operation? What were you doing there?
Yeah, so this is again a huge operation, and huge in every way, and huge in terms of even staff. We had, I think, in excess of 200 geologists in our group. So we're talking about a very big operation in every sense. And the way that Newmont did it was that the geologist and the geology group is integral to the production. So that's the production side of it. So we're trying to use the geology to get the best possible returns from the mine and try and understand where the best recovery zones are, where the risky parts are from a geotech point of view, where all those kind of geologic characteristics, and everything we did from a production geology point of view is built around the idea that the geology is the best predictor of where things are on the ground and the best predictor of, how to build the optimal mine plan. And that's something that we worked on all the time, including integration with the metallurgists and the mining engineers. But we also had the role of doing development. So we were trying to add reserves and resources through that whole period of time. And, we were adding the Conga deposit, which is a big porphyry copper gold deposit. It's more gold rich than copper, but has both. And it's situated to the east of Yanacocha. That project is kind of on care and maintenance now due to social problems that they had there in the east. Right. But it's a very, very large deposit. We're talking like roughly 8 million ounce gold inventory there and a big copper deposit with it.
So, this kind of brings me to my next question. Mark Bristow, the CEO of Barrick, Newmont's biggest and really only competitor, he said something a few months ago on the order of, and I'm probably going to butcher this quote, but that sort of the future of discovery is for gold is going to be associated with these big copper gold bearing porphyries. You've looked at 500 odd deposits. We're not finding many 50 million ounce deposits these days, and we're finding less and less every year. Do you agree with that statement? I mean, where do you think sort of the future of discovery for gold, and we can throw in copper there, is now?
Yeah, I mean, obviously those kinds of projects have the most scale, those big porphyry copper gold deposits. So it's not surprising that the CEO of the second biggest gold company wants to have those in his portfolio. So that, that I think that definitely those projects are something that they need to consider and need to evaluate. And, but Newmont too, but, those projects, those big projects, this kind of comes around to what we're trying to do at Northwest Copper, but those big projects come with their own challenges.
Mm-hmm. So how long were you at National for?
3 years.
And is Mark the first person to offer you a job?
No.
So you weren't desperate to escape from banking, and this was the first escape hatch you found.
Banking was a very interesting job. Lots of variety, lots of I learned a lot in banking, and no, I wasn't desperate to get out of banking.
Well, the reason I ask is I assumed you probably had a lot of offers and a lot of interest in what you do over the years, and you've decided to leave and run Northwest Copper rather. Why this one? Why now?
So there are a few reasons, and it's a great question because it's a great question from an investor point of view as well. So it just kind of points out why someone would take their assets, in which in my case, some ownership of the company, but also just my whole career and move it that way. Mm-hmm. So one of the reasons is that I wanted to. I did want to build a company and run a company and have the satisfaction of not being an agent, which is essentially what you are as an investor or as a banker. You're involved in this project and you're involved on the side. You're not directing what happens. So I had a long-term interest in doing that. But in terms of taking the leap, I wanted to go and work with someone who kind of knew what they were doing. And so, as Mark mentioned, I've known him for quite a few years. I've certainly watched him closely over his career. And one of the things that I noted about Mark most clearly was that Mark's companies have been able to move through. Mining is a business that has a lot of ups and downs. And those companies have all been able to work through, their good times and their bad times. And so it's someone who not just was lucky and happened to, stumble across one thing and made a bunch of money off it. Mark has built up lots of different companies from various different positions and navigated them through all kinds of different situations. And that experience was really valuable to me. And that was probably, from a personnel point of view, the most important thing that I wanted to do, the most important criteria. The next thing I would say is, just in terms of opportunity from the banking point of view and also from an investing point of view, there are always very few copper development opportunities. And, there are lots of reasons for that. One of the reasons is that copper requires a lot of infrastructure for the most part. The copper projects require a lot of capital. There's a marketing angle to copper. All those things kind of conspire to make it a business that's more consolidated than the gold business, which is more fragmented. So, anytime you can find a copper opportunity that has that kind of torque of an early stage project where you're actually creating something and you think it's going to work, that's much more unusual and differentiated than your kind of typical gold development opportunity. So shortage of copper development assets, and here's one that looks really interesting. And then, we want to highlight and we make a point to try and highlight the grade of this opportunity. The Stardust deposit is exceptionally high grade for anywhere in the world, really, and certainly very high grade for BC. And, as Mark mentioned, in terms of putting the two projects together, we end up with a combination of scale from Quinique and grade from Stardust. And that combination, that grade, it allows us to scale the project to some degree. So, if you think about it, and I know you'll appreciate this as a mining engineer, but, when you have a big low grade deposit, your only opportunity to get the costs in line is to make it gigantic, because that's the only way to get your unit costs low.
Mm-hmm.
If you have high grade, you have high margin. When you have high margin, you have a lot more flexibility in terms of how big you need to make the project to actually make some profit out of a ton of ore. So, it's that grade that really gives us all that flexibility. And then when you put it in a jurisdiction like British Columbia, a lot of these projects are in more difficult parts of the world, or they're at high altitude, or they're in a remote area, or whatever. We can drive to this project. So to me, it checks a lot of those boxes that I mentioned on the review side in terms of risks and so on. The risks are low, the opportunity is high. We have the ability to finance and develop this ourselves. And so I wanted to be in a project where I felt like we were in control of our own destiny. And by having a project that's scalable, where there's a kind of void in the opportunity set, that felt like the right move for me.
Okay, good. I want to dig into a few of those things in a little more detail now. So you mentioned grade, you mentioned, of course, Stardust and Quinique and the different boxes they check. I think it would be good if we could go through, I guess, what I would call the key project facts about this, and then maybe talk a little bit about what differentiates it. I mean, obviously you're both very excited about the opportunity and see a lot of potential here. How does this compare to other copper assets and projects globally? How does it compare within BC? But let's start with, for people at home who don't know anything about this, what is it? What do you guys got in your hands here?
So in terms of the kind of core projects, it's the Stardust Project, which is a carbonate replacement deposit. So structurally controlled, high grade copper gold deposit of, probably 4 to 5 million tons of in excess of 3% copper equivalent. So, we're working on a resource there. So, where we get to on that resource should be out in the next month or so. Mm-hmm. And we only have a resource for a portion of that deposit, but it's an exceptionally high grade deposit. It's not huge, but there's a significant number of tons, and it's unusually high grade for anywhere.
And how accessible is it in terms of mining?
Well, it's going to be mined underground. I think it will be a long hole mine. It's got a lot of consistency, so we don't have issues in terms of a lot of variability that would make the mining difficult. And it's a steep plunging deposit, so it lends itself to underground mining. It's on the top of a hill, basically, and you can drive there. So it's accessible from a mining point of view, but it's also accessible from an infrastructure point of view.
Okay, so that's Stardust. Tell us a little bit about Quinique.
So Quinique is more, on the surface of it, a more typical British Columbia porphyry. So, it's a few 100 million tons in total in all resource categories of, a bit over 0.4 copper equivalent. So, there are a lot of deposits like that in British Columbia. And, what's different about Quinique is the Quinique high grade actually subcrops, and it sits on the upper surface of where the deposit comes close to the surface. So basically, the high grade is nearer and sooner in the mine plan than it would be in most of these deposits. So a lot of copper gold porphyry deposits have what they call a high grade core, mm-hmm. and you see this especially in the Andes. But the highest grade stuff is at depth. Mm. And so you have to mine for a lot of years through a lot of lower grade material to get to the higher grade stuff. Because of that, that definitely hurts the economics. So, getting your cash flow later is not a good thing in an NPV.
Yeah.
So these ones, we have, the open pit, for example, the conceptual open pit at Quinique gets into grade almost right away. So the geometry of, it's not just the fact that you have a discrete high grade zone there, but also the geometry of that high grade lends itself to a more profitable mine plan.
And so what's the implications of this? That one, it reduces early capital costs, and two, it gets the company potentially cash flowing at an earlier date, and obviously you have that money coming in that you're putting back into the project.
Exactly. So what it means is that we can build a project, as I said, of the appropriate scale and with a CapEx number that we can manage and handle ourselves. And then, as you say, you mine the high grade early, which is unusual in a deposit like this, and so you get paid back sooner.
Yeah,
and you get your cash flow sooner.
And the other thing to throw in there, Jamie, just as an aside, and this speaks to sort of the operational flexibility that Peter was talking about earlier, is that while that Quinique high grade open pit component is being developed, you're accessing 3% copper equivalent at Stardust just across the valley to supplement that early upfront cash flow, right? Mm-hmm. So it looks amazing from, for the first couple of years as you're combining and blending Stardust with Quinique.
Yeah. And, I'm kind of drawing into this a little bit because I just want people at home to sort of appreciate this situation because, I think, Peter, you said it earlier. Mark, you've worked with a lot of companies. You've had success through great markets. You've had success through poor markets. And as well as anyone, that it's hard to finance in a bad market. It's hard to raise money. And if you can raise money, you're not doing it on the best of terms. And, I think it's so important that companies, right now, it's a bit of an easier market to finance, especially for copper, but that you guys can put yourself in a position where you can be cash flowing relatively quickly. That'll give you the optionality and put you in, really build you a strong balance sheet. So you're not as much at the whims of the market, be it in 6 months or 6 years from now when we find ourselves in a down position.
Mm-hmm. And on that note, a typical BC porphyry, running 0.35 to 0.4 copper equivalent with 300 plus million tons, maybe, $500 million tons, you're looking at $1 billion plus to build that. Mm. Right. And so a junior developer or a pre-production company developing its first asset, like we are not going to be able to fund that without bringing in a partner or, selling off part of the project or whatever. But the capital nut that we're talking about here, at least based on our own sort of high level assumptions, is, half of that, right? So this is not a project that looks like it's going to be a big capital cost when you compare it to other copper gold porphyries in BC.
Yeah.
I think that.
Oh, sorry, Peter. What were you saying?
Well, what I was going to add there is that, and if I put on my fund manager hat, is that, so what Mark says is absolutely correct. What the interesting result of that is that because we can build this ourselves, that gives us the option. We still have the option to sell it, but we also have the option to buy it. And because of that, if you think about when you're a fund manager, one of the things, when you're invested, for any investor, you want to look at what are the ways you can make money out of this investment. And you want to have more than one. You don't want to just be invested in one thesis. You want, because things don't always go like you think they're going to. So, you have your plan A, put this project into production. Plan B, someone buys you. You need to have and so I would argue that, once we have a PEA out and just in general, that because we have that extra optionality and that extra ability to control things ourselves, that we should be trading at a higher premium than someone with an equivalent project who their only option is to have it for sale.
Right. Well, I guess it allows you to sit at any potential future negotiating table from a position of strength and not be really beholden to the price you're offered.
No, exactly. Because, if you can't raise the capital, then you really have no choice but to sell. So we don't want to be in that situation. And this project allows us not to be.
So let's talk about what stage you guys are at right now. Where are you in the life cycle of this project and what's coming down the pipeline?
Sure. So I'll talk about Quinique and Stardust, and then maybe Mark, if you want, we can talk a little bit about East Niv too. So at Quinique and Stardust, we, Stardust, we will have our first resource out in the next month or so. So, and there is a resource for the upper part of that deposit, but this will be the first resource for the entire deposit. And that's a major milestone that, will allow us to really go out and really talk about and bring attention to the unique high grade nature of this deposit in a much clearer way. At the same time, we are going to be drilling starting in May drilling out in more detail the higher grade portion of Quinique. So that high grade portion of Quinique is critical to putting those two projects together. And although there is more wide-spaced vertical drilling that goes into that deposit, we need a little more detail and a little more resolution on that. We think that will allow us to design a mine plan that targets the high grade in a more effective way than the existing drilling would allow. So we need to get a little more resolution. We potentially can be a little more selective, which means that our mine grade at a minimum should be higher. And then so we'll complete that resource, and that resource will be out by the end of the year. And, we have the metallurgy and all that. And I mentioned we have metallurgy coming out. And in fact, we have metallurgy now, preliminary metallurgy from Stardust, which shows recoveries, plus, in the mid 90s for copper and in the 90% range for gold. So these are exceptionally high recoveries.
How does that compare to other projects in BC?
So I don't have the average numbers for BC, but what I can say is that in copper deposits, typical flotation kind of recoveries would be in the kind of high 80s, maybe.
Okay.
So higher, and that's partly a reflection of the grade. So when you have higher grade material, you have fewer other things with the, if the sulfides are clean and coarse, which they are, then you end up with high grade, and high grade usually means high recovery. So we benefit from the high grade, but also we recover a big amount of it. And the metallurgy is very simple and straightforward.
Okay. Mark, I'm thinking back to our last conversation, and, at the Oxygen Group, you guys have made a lot of money, and shareholders a lot of money, by basically buying other people's work at rock bottom discount prices. Does this sort of fit in to the typical Oxygen model, or is this a little earlier stage than you tend to have gotten involved historically?
No, I think this is right in our sweet spot, Jamie. I mean, on the Stardust side, which is where Sun Metals came from, we came into that asset. Cost of entry was very, very modest. And the thesis there was, this is a system that has deeper roots, and let's go after it. And lo and behold, our first drill hole into it was 100 meters of 5.5% copper equivalent. And it sort of just blew the doors open. And Teck came in for a 10% interest in Sun Metals, and we raised capital to continue expanding. And we were successful in building continuity up and down plunge over 900 meters of continuous high grade material. And it's still open. It's still an exploration target, and it's still going to grow. And so that was our starting position going into this merger. And when you look at where Serengeti had taken it, it itself was now a data-rich project with clear visibility on a high-grade core that could complement what we had over at Stardust. And really there was and they were trading below average, sort of when you compared it to the peer group in BC. So it was a project that needed a little bit of resuscitation and a little bit of a repositioning itself on its own. And now putting these two together gives us an opportunity to sort of reimagine the whole altogether. This isn't just about putting a new complexion on something old. We are reinventing and reimagining a whole new future for this combined marriage.
Okay. Guys, I think about what Peter said earlier, and building that optionality in there, and in the event you don't take this all the way to a production scenario, what is the appetite you're seeing these days for majors to acquire this style of project in British Columbia? Is there a potential buyer down the road that's hungry for this sort of asset?
There's a lot of interest in ground in BC right now. I mean, you saw the GT Gold Newmont deal. We've seen Newcrest come in the last few years. There's a huge amount of interest in gaining exposure to this part of the world because you have projects with scale, and it comes back to your comment about Mark Bristow and Barrick and so on, is that you're looking for projects with scale in a part of the world where where it's easier to do business. And so this is a great place to pick up ground, work on it and to build kind of a long-term plan for reserve replacement and exploration and so on. So there's a huge amount of interest, and we have lots of interest in our project. We've had conversations with various producers, and I think the right time to do a deal is something that you need to figure out, and we're pretty early on, so it doesn't feel like that it's exactly perfect for us, but there's definitely an interest. You could describe it as somewhat of a land grab. I think people are interested in getting some real estate in this part of BC because it's a great place to be and a very popular place to be.
Okay, guys, I want to shift a little bit and talk a little more generally about copper. Mark, you've had a lot of success in gold. Obviously, Peter, coming from Newmont, you've got a background in gold. Why copper? Why now? Do you guys have a feel for that? Is there a reason for that?
I'll let Peter go first, and I'll backfill.
I was going to say Mark could go first, but I'm happy to go first. That's fine. First of all, one of the things I think that there is obviously a copper story, and I wouldn't have been as attracted to this opportunity without that. There's also in the case of Northwest Copper, there's a copper gold story too. So I don't want to spend too much time talking about the gold part, but having gold in your deposit also provides a lot of optionality in terms of financing options and so on. So there are a lot of attractive things about having a mix of copper and gold in a deposit. It just means that there are different ways you can raise money when you go to build it that you might not have if you had a pure base metal deposit. But strictly speaking on the copper side, there are lots of things that have been happening in the world in terms of the ability to operate and to make the most of these big deposits, that some of which you mentioned, and some of those are political. If you think about some parts of the world are more difficult and harder to get into than they were 10 years ago or 20 years ago. When my career was growing with Newmont, the world was basically opening up. So every year that seemed like there were more and more countries we could go to.
Yeah.
That's not the case right now. Right now, it feels like there are fewer and fewer countries that you can go to. And some of those countries that you can go to are more challenging. The deposits, there are lots of, I would say, there are quite a lot of big undeveloped porphyry copper deposits around, but a lot of them have characteristics that make them very expensive to develop or very complicated to develop, or some combination of the two. If you look in the Andes, a lot of those deposits have become more rich in arsenic, for example, so they're more difficult to process. Some of them are have deposit shapes and characteristics that make the cash flow is way later in the mine life than it is in what we're talking about. So those, you need someone with exceptionally deep pockets to build those things. So that's, a very light, brief touch on the supply side. And then, on the demand side, we've got a lot of changes, as everyone knows now, in terms of how people foresee the kind of energy economy in the world. And, that includes a lot more electrification of things. We're talking about electric cars and other, opportunities to reduce the use of fossil fuels. A lot of those require energy infrastructure. That energy infrastructure requires a lot more copper. And so, copper demand is going up with lots of room to grow at the same time as the supply. The supply, people say, oh, well, deposits are getting deeper and harder to find. Well, I mean, that's always been true, right? Like, nobody looks for harder deposits to find when they're already easy, when there's still easy ones to find. But it's a trend. It keeps going over time. It becomes more and more difficult, and the ramp up of demand at the same time as the supply comes off and the supply becomes more challenging is important. And I also think I don't hear a lot of people talking about the fact that it's the number of countries and the areas of the world you can get to are actually fewer than they were maybe 15 years ago.
Yeah. Peter, something I've been thinking a lot about lately, and a lot of people have been thinking a lot about lately, is I don't know if I want to call it a trend, but the increased importance of ESG in the decision-making of investors and financiers. Did you see this as a growing concern or a growing component of an evaluation on whether to invest in something during your time, both as a banker and as a financier at a fund?
Absolutely.
And how is it shifting the capital allocators, the investors' decision making? Is it more than, okay, this thing has an X IRR or an NPV and can do this? How is it affecting the way capital is being deployed into this sector?
So there are multiple ways to drive change in the way that businesses operate, and one of them is regulatory, which comes from popular vote or popular views through politicians, and the other one is through the way people vote with their feet in terms of where they put their money. And speaking more specifically about the money side of it, which I think is really what you're asking, if you look particularly in Europe right now, a lot of investors and a lot of funds have stricter and stricter criteria in terms of what are the things that they're willing to invest in, and how do they measure how those companies that they're investing in measure up on an ESG basis. Mm-hmm. And remember that institutional investors have to raise money themselves. So they need to be able to show to their end investors that the investments that they're making are compliant, whether that be the government in a sovereign wealth fund or individual investors or whatever. So there's pressure on all these people to comply, and then the people have their own views about what they want to see and how they want to drive change in the world. So that's a huge thing. And I've done a lot of marketing. This is more of a Northwest Copper story. I've done a lot of marketing already. In fact, I think I've done more than 50 investor meetings since I joined the company in the last month. And a bunch of them were Europeans, and a lot of those ones asked some very specific questions about what the project looked like, going forward. And, one of the things they wanted to know, for example, they wanted to know, where does the power come from? If we're going to build a project here, where does our electricity come from? And, in BC, electricity is 95% hydro. So we start off in a really good spot in BC. The other bit is, if you think about, energy intensity, which is something people probably will look at, a higher grade deposit uses less energy per equivalent pound of product or whatever your product
so
may be.
Energy used per pound of copper produced.
Exactly, which is not a metric that I've, I don't know that it's particularly well developed, but the reality is a higher grade deposit is less energy intensive than a lower grade deposit. All of these things are really important. And, working in a place like British Columbia, which, is, first of all, especially now, a straightforward jurisdiction, but at the same time, a jurisdiction that has very high standards, globally, and people think of it and know it as a place where people do business the right way, and we're part of that.
Yeah. Do you think, I'm kind of asking a leading question here, and it's what I've been thinking about, but the capital allocators pushing the money down into funds, pushing the money down to the companies. Do you think they are going to be pushed to be more inclined to invest in a place like British Columbia, where they do have high social standards and have high environmental standards, compared to many places we can all think of in the developing world that might not have had these things implemented at this time? Is there going to be a drive to that, or I kind of look at it the other way, or do they want to see money driven into the Congo, into Mongolia, into places where that money can help sort of rejuvenate the economy and put these things in place? How are they thinking about this?
Yeah, it's a challenging question, because there's maybe not an exact answer to it. Yeah, I think what the challenging part from an investor's point of view is that when you're investing, for investors, they have a range of unknowns. And when you're putting your money into something, you're trying to reduce your unknowns. So you want your investment to be as simple and straightforward as possible. And one way to do that is to work in a jurisdiction that is more straightforward and more. So in British Columbia, we know what the rules are. Yeah. We know how to follow them. We know how to meet them. In some other parts of the world, that's not true. And while you're correct that you can, I'm a believer that you can help other parts of the world by making investments there through mining and through other things, the reality is sometimes you can't be sure how that investment is going to work out and where that investment is going to go.
Okay, and so in some ways it's a matter of, I guess, reducing the potential for unknown unknowns, I guess would be a good way to say that, and what can happen with that money in those situations.
Yeah, I mean, try to focus on your actual investment thesis and keep the noise out of it, for lack of a better term.
Fair enough. So guys, all right, we're coming up on an hour here. I want to be respectful of your time. I know you guys both have busy days ahead of you. What else should people know about what you're doing, what's coming down the pipeline over the coming months and potentially years?
Yeah, well, I'll touch on the pipeline here. We've talked a lot about our flagship project, and really that is the underpinning of value that backstops the whole company. But with this merger, has come a whole pipeline of projects that span sort of grassroots early stage discoveries to slightly more advanced with a starter resource in hand to what we just talked about at Quinique and Stardust. So with Northwest, you get the advantage of a jam-packed pipeline, and now we've got the budget and the capital to go allocate across that pipeline so that we're making new discoveries, we're growing existing resources, and we're advancing, development stage projects to the next stage. And our most exciting drill-ready, we'll call it greenfields discovery, is called East Niv. And East Niv
okay.
came out of the Serengeti side of the merger. Over the course of the last 2 years, Dave Moore and his team on the ground there did a lot of great work, went back to first principles, went in with a thesis, and 2 years later have come out with a beautiful looking copper gold porphyry target that's outcropping, that's got coincident geophysics, all the right stuff, coincident geochem in soils, and hundreds of meters of outcropping ore grade mineralization sticking out of the ground in a bunch of different places in exactly the right rock package, just down the road from Kemess, that has never seen a single drill hole in it. So we're going to go in this summer, sort of midsummer, and allocate 3,000 meters for a phase 1 drill test at East Niv, and hopefully come away with a brand new copper gold porphyry on the map in BC, which is going to generate, or has got the potential to generate, a huge amount of excitement into Northwest copper.
Mark, for all the geology nerds out there, how many meters are you going to be drilling this summer? What are you going to put into the ground?
We're going to start off with about 10,000 and sort of play it by ear from there.
Okay. 10,000 meters. And is that just at East Niv, or is that across the package?
It's across the portfolio.
I was going to say that would be a lot of a lot of drill holes, but that's exciting. So that's a lot of drilling. I would guess that's got to be at least $5 million worth of drilling this summer.
Yeah, we're going to start out with about a $10 million budget.
Okay, so I'm way off.
Yes, well, I mean, that's you layer on a bunch of other things, geophysics and geochem and on, and you end up with about a $10 million budget all in. So it's an aggressive program. We believe in the power of discovery. We believe in the momentum that this pipeline can generate, and we've raised the money to go put the work in the ground and create value. And that's what we're determined to do.
You guys have just released some impressive metallurgical results, which we touched on. Is there any key catalysts over the coming months that people should be keeping an eye on and paying attention to?
I mean, the key catalysts are metallurgy, resource updates, drill results. So we're going to start drilling in the next month, roughly. And results will start trickling in sort of midsummer all the way through the fall to the end of the year. And we're going to culminate our field program and all our efforts in a bunch of new resource estimates, and then ultimately a PEA on Quinique and Stardust. So it's going to be a very catalyst-rich year, lots of momentum, hopefully lots of good results to back up all this hard work, and come out of it having hopefully a new discovery on our hands at East Niv, and having repositioned Quinique and Stardust as sort of BC's newest high-grade development stage copper gold project.
All right.
I mean, it's a pretty remarkable set of catalysts, really. It's, you were talking about 2 resource updates and a PEA and all that drilling. I mean, it's not insignificant, plus the metallurgy.
Okay. Well, gentlemen, thank you very much for your time. And everybody at home, thank you very much for watching. We are talking to Marco Day and Peter Bell from Northwest Copper, which is Oxygen Capital's newest company, focused on copper in British Columbia, of course. Gents, have a good day, and thank you so much for your time.
Thanks, Jamie.
And for people who want to learn more, where do they find you? Is it northwestcopper.com?
.ca.
.ca. All right. Thank you very much.